In this episode of the podcast, I talked to Dorothee Rains, the founder and CEO of Aurelio LLC, which is a boutique research and consulting firm that provides investment advisory services to institutional investors and family offices. And in this episode, we talk about the asset management industry and related applications of Python. So if that sounds interesting to you, then you're welcome to join us. I started my career at Wells Fargo as an investment banking analyst, helping investment grade companies syndicate revolvers and term loans and bridge loans to banks. And while I was there, I wanted to get a big bonus and I wanted to get promoted. And so I was looking for ways to impress my boss and started hearing about people at JP Morgan and Goldman Sachs using machine learning specifically on the trading side of things, which was different than what I was doing. But I became interested in it. And long story short, learned enough Python to create an algorithm that was useful for my team. It did what I wanted it to do for my career. And after pitching the president of the investment bank to make a position for me to build machine learning models internally, he ended up not going for it. And so I left and started PyFi, which used to be called Machine Learning Edge. And the purpose of the company was at that time to teach investment bankers how to use machine learning algorithms like I did to analyze Bloomberg data and provide better analysis to clients and that kind of thing.
So what can I ask? What did the algo exactly do?
One of the questions that we helped treasurers and CFOs to answer is how much liquidity do I need? Because there's a cost to maintaining cash on the balance sheet. There's a cost to maintaining a revolver of a certain size. So you don't want too much, but if you have too little, then you're flirting with some kind of liquidity risk, like maybe you need to raise capital in a more expensive way when you run into some unforeseen shortage. So the algorithm looked at Bloomberg data, and it used specifically a gradient boosting regressor to identify or to predict based on not just comparable companies, but a broad array of companies, how other treasurers and CFOs would size their liquidity, and by backing out cash, how they would size their revolver.
Oh, interesting.
So
Okay.
we were able to linear regression that we performed for clients prior to this algorithm had an R squared of 0.44 when we were basically answering the same question. With the gradient booster, we had an R squared of 0.88. So we were able to basically double our explanatory power, the explanatory power of our model, which allowed my boss to go in and say, this is how big your revolver should be, and if you're deviating significantly from this number, you should at least have a good reason for it. And we're using machine learning and nobody else is, and so that helped him to win the deal and ended up being good for me. So that was how I encountered Python at first and started teaching it. We distributed our classes through partners like Wall Street Oasis and Corporate Finance Institute and the Marquee Group in Canada for several years, which was a nice business model for me because I just produced content and they handled marketing and sales and customer service and all of that. But when Gil came on in 2021, we decided that we wanted to start marketing directly to customers. We wanted to own that relationship. And ever since then, we have not been able to figure out how to do that profitably. We recently had a conversation and decided that we are able to pitch pretty well to a finance professional who wants to learn Python why they should learn it from us. But we are not able to adequately answer the question, why should any finance professional learn Python in the first place? Like if somebody is an investment banking analyst syndicating revolvers and like doing the exact thing that I was doing, I can tell you why it would be useful. But I don't have experience in like investment management, for example. I don't understand the applications. And so I can't adequately answer why someone would use Python as opposed to Excel or any other tool that's available to do tasks that finance professionals do. And we need to understand, are there any opportunities? Like, are there any problems for which Python is the best available solution compared to every alternative? Or is there not? Because if there's not, then we don't have a business. If there is, what exactly are those problems? And who exactly are the finance professionals who are responsible for solving them? Because those are the people that we need to be talking to. And in order to answer that question internally, we've done research on job postings. We've looked at over 4,000 jobs across 43 different companies and are identifying postings that require or prefer Python in finance roles, and we're looking at we're looking for clues in those job postings that tell us how Python will be used, like the kinds of problems it will be used to solve. But also, we're talking to people like you who have experience in different areas of Python or in areas of finance using Python, and so that's what I'd like to talk to you about today.
Great. Very cool. Have you, in those job postings, have you been able to determine within like my field, investment management, if there is now a strong preference for any kind of coding background?
Yeah, more in investment management than in other sub-industries of finance. Although I haven't finished the analysis, so my detail will be limited in the answers that I can give you. But what I have seen is across all of the jobs that we looked at in finance categories, about 7% require or prefer Python, which is not a majority, but it's a significant minority. There is demand for this skill in finance jobs. In investment management, I think that number is closer to 30%.
I'm actually surprised. I'm always surprised it's that low.
Oh, really?
Yeah, I would have expected that to be a bit higher, just because now it's like the in vogue thing, right? To put that in your job posting. Even though I can tell you from experience, like now I consult. I left the precise investment management position that I held in 2022 because I wanted to be by myself, consulting first, and then at some later stage, probably getting my hands on managing money again. But right now, I'm consulting with a lot of asset managers, and what I can tell you from experience is that pretty much everyone who's not a quant, like who doesn't position themselves as a quant, they are from the like they have the old training that you would go through in any management school, right? If you do an MBA or any finance study program, they do some statistics, and the furthest knowledge that they would have of any statistical modeling is maybe a Probit model.
You said what kind of model?
Probit.
Probit?
Yeah, Probit. So like a probability distribution modeling.
Oh, okay. I'm not familiar with that term.
Regression.
Okay.
Right.
Got it.
Anything else they wouldn't know because they weren't trained on that. And so given that they don't know, what do they put in the job posting? Yeah, sure. If people know Python, that's great. But they don't necessarily know how to apply that.
Okay. So you're saying that the hiring managers who are writing these descriptions know that Python is a tool. They have a vague sense that it might be useful, and so they put it in the job posting, but often are not clear on how exactly to apply it?
That is very correct, yes. And that's my experience from the corner of investment management that I come from. Obviously, that's very different for any kind of quant shop.
Yes.
Obviously, right?
Different universe.
Yes, exactly. And they would strongly prefer someone who has actually a programming background or like a STEM background where the programming skill set is now built in.
Yeah, it seems like they're often indifferent to whether or not you studied finance before.
Yes, exactly. Whereas those jobs that are geared towards a finance major, it's very different, right? Because, as I said, the finance people, the more senior finance people, so far they haven't really been exposed to a lot of advanced programming. It's called, maybe they've been exposed to some coding, but most often not, actually, from what I have seen. Even the larger shops, like where I was prior to leaving and being on my own, we managed 65 billion. And we were a very small team, like maybe 17 people or so, of which even fewer people had a more sizable impact on the portfolio. And the most that someone was able to code was to run some code on eViews, but not necessarily something more advanced, right? Not a categorization problem, not a classification problem. All of that was totally foreign. And from what I know is that most of those kind of shops right now, they're still in that position because leadership is senior, right? I mean, they're 50, 60 years old and they've never.
Which means back when they were crunching the numbers, Python was not as popular a tool, partially because it didn't have the libraries that it has today, like scikit-learn wasn't around, NumPy and
Of
pandas
course,
weren't around.
exactly. Exactly. And so, I mean, that poses all kinds of issues if you want to bring Python to their fingertips, right? Because if you want to convince someone who's a portfolio manager at those kind of shops, discretionary shops that maybe use some quantamental input, they like to interpret things themselves. I mean, that's their edge, really, right? The
They
experience
don't
that
want
they
their
have.
analyst to give them a black box and say, trust me.
Yes, exactly. Even though sometimes it might be worth doing, right? The black box might actually beat the portfolio manager. Um, but they would at least like to know why. Also, because the whole business model of discretionary money management is somewhat built around telling a story. So if you manage money, the client always wants to know why you invest, where you're invested, and the reason you give them is not, well, it's because they are squared with oil and consumption is, I'm making this up now, point 0.8, and hence we predict that X. Right? They want to hear, well, it's in the past, every time that oil has dropped 20%, it's given the consumer a lot more buying power. And so we predict that, these sectors that have been lagging are going to gain a lot. So that's the kind of story that the clients want to hear. And
Because it gives them confidence in the strategy.
yes, even though it might be sometimes, let me tell you, a fictional story might be better than the real story.
Why do you say so?
It's human psychology. Sometimes fictional stories, that's what the market runs with, and that's what clients like to hear as well. It's something that is colorful and that they can vividly imagine. They trust you. If you give them some numbers and some convincing story of why something's going to play out, they will trust you. And that's the business model, right? Apart from needing to beat the market.
And the alternative maybe would be you're a Renaissance or an AQR and you're known as a quant shop and like you are the black box investment manager for the client and they say, you've done a good job so far, take my money and do your thing.
100%, exactly. Whereas, the discretionary manager, because they need to tell a story, to some extent, they put their knowledge on the line while doing that, right? They can't just say, "Oh, it's a black box that calculated something that just didn't play out." Even though you have to program that as well. So there's discretionary input in quant management as well. But within discretionary management, you put yourself on the line. And if you don't know, if you feel like you don't know, you don't have power over what goes in or what comes out, it's tougher, right?
And so are you saying, tell me if I'm misunderstanding your point, but are you saying the senior person is the one talking to the client? And that senior person needs to be able to tell the story of how this strategy works. And if that senior person doesn't understand the algorithm that's influencing the portfolio, they're not able to tell that story. So they,
Correct.
okay.
Correct.
Well,
Or,
and so,
you might not even want a black box to kind of run the portfolio, but say you do some kind of analysis and that analysis tells you to do something, not necessarily to invest, but to go in a certain direction or to give you clues of what could happen. Even that senior management wants to understand that for right now. I think there might be some shift within the younger generation coming in, also because Python is ubiquitous. It's cheap to use because the libraries are free. It's amazing. And people want to learn, and there's quite a lot of material that they can teach themselves with, and you guys are working on that as well. But even for the younger generation, the challenge is how do you convince senior management that this is something that they should do? So to give you an example, from my experience, because what's been taught so far and how econometrics works in the investment management industry, what people know is, okay, you need to build a model, probably with some kind of regression, and the input that you have, that you use the model with, needs to be well cleaned, of course, and it needs to be sparse, right? You don't want to overfit the model. And you need to understand what goes in, and then something gets spat out, but people even calculate in their head, okay, I see this kind of coefficient, so does that make sense? And there's a huge amount of confirmation bias and how these things are discussed. And now, if a younger analyst comes in and says, well, I ran this with a neural network, they don't just use 4 variables in that, right? The approach is, for a neural network, you overfit. You want to overfit. That's the philosophy behind that. Of course, someone who's been trained with just plain old econometrics, and all they know is some kind of regression, how you should approach that, they would say, oh my God, no, I don't want that, even though it might be vastly superior.
And so then the problem there is literacy, familiarity with the models. So there's a political dimension to this decision, if we want to call it that. Not exactly political, because it is practical. The senior management at an investment firm needs to understand the tools that are producing their analyses upon which they're making their investment decisions, not least of which so that they can communicate effectively to clients. But you are saying there at least may be some, if there weren't opportunities to use Python and machine learning models as an example profitably, we wouldn't have these quant funds that are hiring people with like deep programming experience. So I guess what I want to understand is, apart from that political dimension, what exactly are the opportunities to apply Python in this space? And I'm interested in analysis that would help a manager to make better investment decisions, but I'm also interested in things like automation. For example, I just don't know how the investment management industry works. I don't know what kinds of tasks people perform in that world, but I imagine that there are probably some repetitive tasks like generating reports and emailing them out to people that could be automated with Python.
Let me talk about that automation first, because I think that from a business perspective for you guys, that is something that I'm seeing more and more right now with clients. My clients, all of them are discretionary, not automated.
Not quant funds.
No. Some of them are equity focused, some of them are macro, so FX commodity focused, but all of them discretionary. So I'm seeing more and more now that those clients need to, my clients, okay, let's call them portfolio managers, asset managers. What I'm seeing more and more now is that those asset managers need to communicate with their clients on a regular basis, obviously, and that they're asking more and more for automation in the client communication report generation. So equity asset managers, for example, they go through company reports, company earnings calls, and obviously the metrics of the company. And then they like to obviously add their twist, their views on that, and why that investment is good or bad if they de-invest it, right? And a lot of that report can be auto-generated. Actually, quite some platforms now do that for you to some extent, like Bloomberg. They do a earnings call summary or something like that. But I have asset managers that I work with that actually like to do that themselves, meaning they like to have some kind of automated backend that goes through the earnings call and summarizes it in a language that the asset manager uses in their client communication, and then they use that output and put their twist on that. So this is something, for example, that I'm seeing more and more that has started for me last year.
Okay.
Yeah, it's quite new. I think it's because people are now seeing, for example, on Bloomberg, because that Bloomberg intelligence does that. To some extent, they say, "Oh, that might be interesting," and now with ChatGPT and all kinds of LLM that they can potentially, not them, but someone can write that for them. They can see, oh, this is so much easier, and maybe we can even filter out things that we else would have missed. So that's definitely some automation that could be interesting for you guys to break into the asset management world.
Okay.
Yes, I think, actually, I'm not sure about the numbers, but I think most asset managers here in the US are, in terms of AUMs, are equity focused,
Okay.
I would think. Not just hedge funds, but also family office focused. And so I would think that if you do something very simple that people understand, something like that, and offer that, that could be a good start. But that's obviously just a very, very tiny sliver of what else can be done, right? And the next step would be then the breaking into the model world and trying to explain why it would be so much better to not just use their traditional regression approach, which they can still keep, that's fine, but why it might be worth adding to that suite of models that they have.
How have you applied Python in your work in that world?
So my approach was what they would call quantamental, but my background, I'm a mathematician by training, so
Okay.
I care a bit less about the story. I always come from the model and then try to get the story from that. That's the explanation. I try to sell it like that. And what I found was very helpful in this kind of quantamental approach for asset managers who like to understand, who like to be able to explain, is classification. So no one tries to precisely predict, say, GDP, and then say, oh, if I can predict GDP exactly, I know where the price of oil is going to be, and hence I can. That's not going to work, right? What they like to know is, well, and what kind of investment environment are we in right now? What are interest rates going to do? Are they going to go up? Are they going to go up strongly? Are they going to stay somewhat stable, fall quickly? And other asset classes, same thing. So most of the all of the macro background people and most of the non-macro background people use some kind of macro input to do that. So if you speak to any investment management professional who's not a pure quant, they'll probably have some opinion on what the economy is going to do, where unemployment is going to go, what kind of policies are going to be implemented, is it going to be good for growth, or what the dollar is going to do, things like that. So what I found hugely helpful is very simple classification to start, to kind of sell what I was analyzing, and then say, well, right now we've had this, an expanding economy, and this is the environment that we've been in. And now with the development that we see here, and now insert some fluff story, it is very likely that we will see some kind of deterioration. And so we enter into the next regime, which means that I'm making this up now, equities are going to underperform bonds. These kind of stories people really listen to because they think, oh, this could be some additional analysis that can strengthen what I already think, or, well, it could actually open my mind and tell me something that I otherwise wouldn't have seen. And it's easy to understand. Easy to understand in the sense that it's not going to help you much if I tell you, well, this is going to grow 3%, unless you know what the other stuff is going to do as well. But if I tell you, well, this year is very likely going to be highly volatile And, these kind of years that have, again, I'm making all of this up, right? That come out of strong growth and where you see leading economic indicators roll over, all equity markets worldwide underperform or actually have absolute negative returns, and hence it might be worth shifting allocation, something like that, right?
Okay.
That's what people like to listen to.
And so in order to develop that model, you're looking at some historical data and you're labeling that data with names of different market environments that you care about that have consistent patterns in the movement of assets, and you're training the algorithm, giving it macro inputs, and then the algorithm is classifying the current environment, and you're saying, if this environment behaves like ones like it, then this is how these different asset classes or how these different macro factors are going to behave.
That's precisely it. Yes, exactly. I try personally, that's my inclination, I try to keep the number of labels lower, right? If I give you 10 different classifications, it might be confusing, but it's very easy to understand if you just say expansion, slowdown, contraction, not necessarily recession, because recession is maybe asset prices perform just like they would in a recession, even though there is no recession. So let's just call it contraction, right? And contraction, recovery. Recovery is missing. So most of the time that's already very helpful. I mean, if you just apply that, for example, you can do that in Excel, which a lot of people like to see. If you just do that on, say, leading economic indicators, and you're able to predict well what leading economic indicators are going to do, you will outperform the market already.
How long have you been doing analysis like this, and how reliable has it been for you?
14, 15 years now.
Mm-hmm.
Not all of that in machine learning, but yes.
How have your predictions been?
Better than just using Excel.
Okay.
Unfortunately, I can't give you a track record because I always had a team-based approach, but I did win some trading competitions. So there is some validity to using that.
Okay.
Even in discretionary management, yeah.
So classifying the current economic environment is an example of an application. Have you found any other useful applications for Python in your work?
Sure. I mean, many.
I would love to hear about them.
Yeah, let's see. I mean, just in analyzing anything, really, again, because people like to understand in the macro asset management world, distilling large data into something that can be understood more easily, that helps.
And do you use Python for that because you're using data sets that are too large for Excel?
Yeah, sure. Also because, I mean, it's so much quicker. Even if you're able to do that in Excel, it's just so much quicker to do that in Python. I also use R, but it's more of a pain than Python.
Could you compare the two for me? When I was at Wells Fargo, I actually worked with a team to develop an algorithm in R before I started using Python, but the rest of the team was writing the code. I didn't do any of it.
I think now in Python, the libraries, especially for machine learning, are more potent than what you have in R. Apart from that, for me, it's always been just about how you have to reference stuff, like how you reference in a matrix, how you index. That's been the biggest issue for me going back and forth. Yes, exactly.
So you prefer the Python syntax?
Well, no preference for either because it is what it is. But if you have to choose library-wise, Python wins. And it will probably also going forward just because the vast majority of people developing are using Python. So
it's more popular.
Yeah.
Okay. Python is more computationally efficient than Excel, which means it can handle larger data sets. It also means even if Excel can handle these large data sets, Python's going to do it faster. Why else have you chosen to use Python? And I ask because I want to clearly understand when it becomes appropriate to use Python instead of an alternative tool. And it seems like computational efficiency is one major reason. That's one reason why Microsoft is not developing machine learning algorithms native to Excel, is because they require a lot of computation, and that's better done in Python. I'm also interested in why Python would be a preferable to R. So it's interesting to know that R doesn't provide the same quality and maybe quantity of libraries as Python. Do you have any other thoughts about that? Why have you chosen to use Python instead of alternatives?
The alternative for Python for me is just R. And well, for right now, I've used them both, but I think I have to start switching completely to Python because of the popularity, as you say, and the consequences, meaning that, for example, to get data, now a lot of platforms where you can get data from just have a Python API.
Hmm.
Right?
And not an R API.
Mm-hmm. Yeah.
That's interesting.
Yeah, for some, I think the R API has been retired. Still works. For Bloomberg, I think it's been retired. Still works, definitely. But the Python support is vastly superior. And there are other data platforms now popping up that just work with Python. If you want to work with a lot of data, there's no way around that, really. If you work in a large asset management firm, you won't have any issue with getting your hands on data, right? So that's probably not a sore point.
Not a compelling reason.
Yes, but for pretty much everyone else, it is, right? Because data is expensive. So again, people that I work with right now, they're trying to decide where to get the data from. And I mean, of course, they probably can't get around Bloomberg, but for example, Bloomberg has the official restriction. I know a lot of people don't adhere to that, but they have the official restriction that you can't store data. You can't download data to store in your own database. A lot of people say, I don't care. But officially, you should not do that. Also, okay, a Bloomberg terminal costs X, but if you want other data, especially on the macro side, Bloomberg is okay, but you might want to use other data sources as well, and then it very quickly becomes quite expensive. Now there are platforms that offer a lot of that data for free or for a very low subscription price.
Are you thinking about OpenBB?
Yes, for example, exactly.
What others?
I'm actually not sure which ones only offer Python, but that was the first one that I had in mind. I think
Okay.
a lot of others, like probably TradingView, you can download data, I think. Some European companies are popping up. And of course, if you have your own broker, right? You can download prices from there as well, very often through API. So I use Interactive Brokers.
You said you use what?
Interactive Brokers.
Interactive brokers.
Yeah. And you can download a lot of stuff from there, like prices, option prices, which is very, very tough to get. The only other source that I find online for option prices is Bloomberg, really. So especially on the currency side. So for that, Python is the winner.
That's an interesting point. I hadn't considered that before. API support. So that's useful. And that's exactly the kind of information that I'd like to know, because there must be some people in the world who are facing problems that are best solved by Python. I just don't know exactly who they are. And so this tells me, oh, maybe someone who is, well, I have a friend who started an investment fund out of school, or like relatively early in his career. I'm sure he wasn't investing in Bloomberg. He probably would have liked to have OpenBB. It wasn't available back then, but I'm sure he would have liked to have OpenBB. And so somebody like that could use Python to get that data, which would be out of reach otherwise. You wouldn't be able to use R. And then depending on the type of analysis you're performing, you might be able to use Excel, or you might want to do that in Python too.
Well, I mean, given that you already download the data into Python, why not continue that?
Why not?
Yes. I mean, so do you guys only want to offer courses or an actual product that does certain things for the investment man, like a platform?
We're focused on education now.
Okay. And you're saying right now in the funnel of clients, you have focused on the problem-aware people,
Right.
but don't know how to address the problem unaware.
Right. And we don't want to just spew nonsense. Like if we're going to advocate for Python, we want to do it in a way that's actually helpful to people. But that requires us to understand what the problems actually are. Like we're problem unaware.
Everyone is to some extent. Thinking out loud here, you probably want to focus on the smaller asset management firms.
Because they would have fewer resources. And so the fact that Python is free and the fact that it would give them access to data that's free or cheap would be more compelling than a large asset manager?
I would think. Large asset management firms, on the other hand, they have a larger budget, right? So if you do a program, for example, that is branded for the firm, you might be able to sell that a bit better to just generate more revenues just because the pockets are deeper. And for those, I mean, I can, from experience, I can speak. Larger asset management firms, the people who would decide whether to buy such a course, they probably don't know exactly what it's going to do, but they need to be open to such a course. They need to say, well, it's coming, and I don't know exactly how it's going to help me, but I'd be open. And there, you would need to have some case studies,
Right.
that show either how an analysis performs better. That's one input, analysis, right? So that they can make better decisions, or trading decisions. You have to be somewhat careful around that, but because people don't, they like to say, well, I make the decision, right, not the algorithm.
Okay.
But you can say, you wouldn't sell it like a trading decision, but you'd say, this can give you a support in your trading that actually helps you to produce X% of alpha, something like that.
So which would fold in under analysis?
With analysis, what I mean there is really looking at data, saying, and what is Great Britain going to do? How is the pound going to develop? What's growth going to be?
What kind of environment are we in right now?
Yes, precisely. In the end, it always comes down to what kind of environment are we going to be in. Trading, with trading decision, I mean more precise positions that asset managers would take. Okay, well, the trading environment is going to be adhering to those four categories that I said before. It's going to be contractionary. Okay, pretty bad. You're pretty bad. Okay, how do you position? That's a different question.
Could you say that again?
How would you position yourself?
How would you position? And what exactly do you mean when you say that?
How would you invest? What do you do with the money that you have? Now that you have,
when you say that, are you saying how within this asset class, how would I allocate my cash? Or are you saying like what price point is attractive, or what exactly do you mean?
all of that.
All of that. Okay.
All of that. So, let's make it simple. Say you're an absolute return manager. So your mandate says you can do whatever you want. You don't have to have a minimum allocation to whatever. And your model tells you Europe is going to be horrible, or Europe is going to be great, whatever. Then what do you do? What do you do? Do you invest in equities? Do you invest in bonds? Which companies do you invest in? Which markets do you invest in? Do you overweigh the euro? What do you do? It's a very different question.
So question number one is, what kind of environment are we in? Question number two is, now that we have a thesis, where do we put our cash?
Correct. Or, if you're not an absolute return manager, do you want to go overweight or underweight? How do you protect yourself if you have to have a minimum allocation to something and your model is going to tell you, well, it's going to underperform there? What do you do?
Could you explain that?
So many asset managers, they have mandates that tell them you have to be allocated X amount in a certain market, and you can't deviate more than minimal amount, 2-3% from that. So your scope of being able to maneuver is much more limited, and you really have to pay attention to be able to outperform the market. Especially if say you're an equity manager, you can't do really that much to outperform because under such a mandate, because you already have to be invested at all times, X amount in every single sector. And then there you can just overweight, underweight, 2-3, whatever percent. Sometimes not that much, sometimes a bit more, it really depends. Whereas if you're an absolute return manager or a global macro manager, okay, you miss out on, 20% of the equity rally, which would be horrible, okay. But there are many, many other assets that you can invest in to kind of make up for that. So that's also a different focus and different goal that they want to accomplish.
different constraints.
Yeah.
Would you mind walking me through other ways that you've applied Python usefully in your work? So it's interesting to know that one useful application is classifying market environments. What are some other examples?
Other examples, something completely different would be, for example, classifying trade outcomes. So it's a very neat application, actually, which I like very much, especially for discretionary managers. What it does is you have a prediction. You say, I invest in the Mexican peso, and I think it will appreciate 10% over the next 12 months. Okay? So what I know then is, of course, the asset. I know the upside that you would like to have, and I know the time frame. Usually, you would also, what you should, not everyone does, usually what you should also say at that point is when you say, well, this trade didn't work out. So basically, you define the downside as well. So what I then have...
At this point, I'm going to exit.
Correct. Yes, correct. So what I then have is a trade that I can label over the next 12 months that you give me, over the time frame that you give me. I can label exit negatively, exit profitably, or, if it hits neither barrier over those 12 months, I can label that 0, whatever. And then you can actually give other input, something that you can measure, obviously, to be able to predict outcome of that trade a bit more. So, simplest thing is if you think the analyst is no good, okay. But something that can be measured, for example, is past performance of the analyst over the past, 3 months, or health of the analyst, anything that you can come up with. And that can help an asset manager actually allocate the money, a discretionary asset manager allocate the money more effectively.
Okay, so in that case, you would be helping an asset manager to evaluate the performance of their traders. Traders?
It depends on how they're structured, right? And sometimes traders don't define the positions that they want to take. They just sit at the computer and try to get
so that's why
right?
You say analyst. The analyst would be determining the strategy, and the traders are just
or
executing.
Portfolio manager, whatever it is, whoever, the analyst that pitches the trade and the portfolio manager who implements. Most of the time, that's kind of how it works. The portfolio manager is the decision maker, and they have an army of analysts that says, I think this, I think that. Yeah, and that's something quite new that I haven't seen applied too much, but in some shops, yes. So I find that very neat. I find that very helpful. It's something that actually really, really helps. Like some older generation asset managers, they say specifically, well, my job as a portfolio manager is to know when someone's hot and when someone's not. And that's precisely what it does.
Mm-hmm. Okay, here's a question for you. What are the names of the job titles that would be responsible for performing the kind of analysis where Python is profitably applicable? Who's crunching the numbers?
Analysts, senior analysts, but then, each shop might have a different position title to that. Asset managers, most of the time, don't have the name associate. That's more like an investment banking title. Mm-hmm. So the number crunchers are usually analysts, senior analysts. They might have different names like macro strategist. Trying to think. It really depends on the shop, Well, it might be even junior portfolio manager. Yeah, I'm trying to think. Even someone like PIMCO, it would be analyst and then portfolio manager. So I would need to get back to you if something else comes to mind.
Yeah, sure. Is it consistently true that someone with the title of portfolio manager would not be the primary number cruncher? There's somebody who's managing people and listening to pitches and then making decisions about which ideas to execute?
Depends on the shop, again, on the size of the shop, but most of the time, yes.
Most of the time, yes. But smaller shops might assign portfolio managers to do the analysis also?
Yes. Yeah, if there is constraint in labor, yes, of course they need to do that. But
that's useful to know. I wouldn't have guessed that. I just, as an outsider, I imagined that somebody with that title would be doing their own analysis. So that's useful.
Well, again, it's not that they don't do any analysis, but they might just consume results of research and then base their decision on that. Yeah, so back to your question, who to target. Ideally, you would like to train those analysts, the number crunchers, but the decision to pay for such a course would need to come from whoever has the budget, the research budget. And that would be, it might be HR, but usually it would also need to be okayed by the senior team leader, which is usually the portfolio manager. So, just thinking out loud again, to help you target that segment of the market, what I think could be helpful is if you try to speak directly to the analyst. I mean, I'm talking marketing wise, not going to the analyst, right? If you address the analyst directly and tell them, look, if you do this, your analysis will be more robust, you will outperform, you will be able to get to your desired position more quickly, get higher bonus, whatever it is that they desire.
Good for your career.
Yes, exactly. In the end, that's what they want, right? And then have them be the advocate to the senior team.
I guess it's not very different than their normal job, which is pitching investment ideas. Normally they're performing an analysis of the market, some asset or some industry. But in this case, they might be analyzing tools and advocating to the portfolio manager that they need to do this training.
Yeah, but then again, it's not that different, because if I say I weren't able to do that or I didn't have those tools and I needed to crunch a lot of reports, I needed to do a lot of number insertion into Excel, download and clean the data, huge amount of time wasted there. And I saw you guys telling me, here's what we do, here's what we help you do. And all this work you do in 10% of the time, and will help you create this beautiful output. And this is how you then present it to your portfolio manager, and you can do 5 times, whatever, even double the work of what you were able to do before. Be like, oh, this is great. And I would then, of course, tell my boss, look, I need to do this or I would even pay it out of pocket, depending on the price.
Because if it gives you an edge that results in a bigger bonus or a promotion, then it's easily worth it.
Of course. I mean, from a business perspective, it's always, this probably even better than I do. It's always more profitable to go to the big firms directly and have them pay a package, but you could do both. I
actually taught a class at Neuberger Berman, when was it? Probably 4 years ago. And so I know that these kinds of firms are hiring firms like PyFi to deliver training, but developing the relationships is difficult.
Yeah. But the younger generation, like everyone knows what Python is. Everyone says, oh, I think I should learn it, but they might not know exactly why, which is why they haven't learned it yet.
Yeah, and that's the question that we'd like to answer. And it sounds like you're saying that we could pitch analysts on Python's ability to deliver superior analysis and also to do that more efficiently, to increase their productivity, maybe by automating things. Okay, so could we dig into that a little bit to get more detail?
Absolutely. So, by the way, I just wanted to finish my thought real quick of
sure.
What else. Application is huge, obviously. But one super simple thing that you wouldn't be able to do very well in Excel is parameter selection or variable transformation to see the relationship between each other, right? So
can you explain what you mean?
Yeah. So say you have a huge amount of data. With huge, I don't mean 10,000 different variables, but somewhat manageable, say below 100. Theoretically, still potentially manageable in Excel, but those variables all have different reporting formats, or you don't know exactly how you want to use those variables, what kind of relationship they have with whatever it is that you want to predict, and you need to find out which variables to choose and how to prepare the variables in that input. If you need to transform them, if there is some relationship, sometimes something that's non-linear, and what ideally you would like to do is some report that shows you that maybe even visually, what you can do with those variables and what to pick, right?
Okay.
So in Excel, that's unthinkable. Right? You spend a lot of time doing that. Whereas Python, it's super simple, right? You can just define various variable transformations, look at the outcome. It's going to take you what,
Just
5 minutes?
test it.
Yeah, exactly. Like you set it up once. If you set it up once, it's going to take you a little more than 5 minutes, and then after that, it's
Could you help me to understand the position of an analyst and the types of analysis that a typical analyst in asset management would be performing? If you can't tell me everything, that's okay. I'm interested in a high level of detail. So if you could tell me specific examples from your experience, even if those are only representative of a part of the work that an analyst might perform, or like if it's only representative of the work a subset of analysts would perform, then that would be fine. But I'd like to understand, like if I'm going to pitch Python to an asset management analyst, I'd like to be able to develop a demo of some work that they would recognize and show them, here's exactly how Python can produce a better analysis. Here's exactly how it can do it more quickly. I don't have the knowledge of the work that's performed by somebody in a role like that. So could you help me to understand at a detailed level what types of tasks might benefit from Python?
yes. Let's distinguish between equity analysts and non-equity analysts.
Okay.
The work is different. So if you're a fundamental equity analyst, what you do on a daily basis, it's not restricted to what I'm going to say, but what you would do on a daily basis is you go through company reports, earnings calls, you go through industry projections, industry reports, and those things. Certain things you get from the company, obviously, earnings calls you'd be on, or you get the summary. Um, you go through company research that is being produced by banks. And that's a management firm, but if you're at the bank, um, you do somewhat a similar job there, which is you go through line items of the company's income statement, cash flow, balance sheet, and try to determine the pain points, leverage, whatever it is that is important to that company, what is very company specific, what is industry specific, and then you try to project what the industry is going to do, how the company is going to perform within that industry. And then you try to project the potential stock price. So that's just super high level. And then depending on what exactly you do on a company basis is you would need to take into account obviously the capital structure. So you need to have some knowledge of what debt markets are going to do, and you need to speak to the management. You need to speak to other industry researchers, which is usually someone at a bank that produces research. So sell-side research you would consume, you would speak to those guys, and then you come up with some projection, some view of what you think is going to happen with the stock price and why. And a good analyst would not just go in and say broadly, well, I think the oil industry this year is going to do well because oil will appreciate, and but they say very specifically, okay, the management has this vision, and this is how it's going to play out because of the market hasn't appreciated this yet. This is why the stock price has underperformed. Or you have a view on the industry and say the company is badly positioned within the industry and the management hasn't seen that yet, or the company has a capital structure that is not conducive of the environment that they're going to be in. Any of that. This is what you would do on a daily basis. A lot of that can be automated, obviously. What you would also do probably is download a lot of data from probably eViews or the CRISP database, and you look at earnings projections. Oh, this is actually a nice application now that I think of it. So what might be interesting for some analysts is to help them develop proprietary indicators, so some nowcasting indicators.
What casting?
Nowcasting.
Nowcasting?
Yeah. So have you heard of nowcasting GDP?
Mm-mm.
No. So what they do is, so you know that GDP comes out every 3 months, and it's reported already with a little bit of a delay,
Okay.
right? So it's the case with all macro data. Um, and to some extent with company data as well, right? They don't tell you every day, this is how much we earn and this is how much we think we're going to make, but
Mm-hmm.
they only tell you with somewhat of a delay how much they earn. And what you can see, though, real time is what analysts project the company is going to do. So, most analysts on the sell side do that. Obviously, they look at, okay, where is everyone else? Let's try to not deviate too much from that projection, because I'm not going to make much if I'm right, but I'm going to lose a lot if I'm wrong and everyone else is right.
Mm-hmm.
So most of the time, the variance of those projections is fairly. But of course, as an analyst, what might make sense is if the analyst is so inclined, is to be able to say, well, those projections of them are very much out of line with what my model says where those projections should be because of whatever numbers I'm putting into the model. So to give you the example of the nowcast GDP, what has been done in macro research is they say, well, GDP is just a collection income from various sectors in the economy, right? And many of those income streams we can actually observe somewhat real time or close to real time. Where we can't observe, we might be able to extrapolate. And what they developed is it's called nowcasting models. They have that for CPI now as well. Where you can see every day where, given the stream of data, where GDP would be reported. Then over time, you can see that actually converge with the quarterly GDP forecast. So very interesting. Maybe something like that could also be interesting for an analyst to have. And this is just fringe knowledge or fringe wishful thinking, what I would have liked to have as an equity analyst. Now, for non-equity analysts, the work is a bit different, because there you don't look as much at company reports. You look a lot at all kinds of data, really all kinds of macro data. What would be super helpful there is...
And you're thinking about foreign exchange, commodities, that?
Yes.
Yeah.
Correct. Yes. I mean, those are prices which you have on a daily basis, but you have a lot of them. So, classification or distillation of data, already super helpful. But you also look a lot at macro data, more so than equity analysts. You look at global macro data. And to be able to distill and convey correctly the relationship between that macro data at any given point in time is helpful. And of course, to be able to fill the gaps, because that's really where a lot of informational advantage lies, outperformance in the end. So by that, I mean, again, if we look at macro data, it's very sparse. It's not reported very often. We're lucky if we get something on a monthly basis, right? But if you're able to fill those gaps of that sparsely reported macro data
through nowcasting,
for example,
interpolating some factor.
Yes, for example, there might be different methodologies to do that. Or something that's known, somewhat applied, but not ubiquitously applied is, for example, the modeling of the yield curve. So what has been known since the 90s is PCA modeling, principal component analysis modeling of the yield curve. That was Litterman-Schenkman who did that here in the States. And they said, well, to model the yield curve, you need to know 3 factors. Basically, it's level, slope, and curvature. Okay, great. Knowing these 3, you can model the whole yield. So what do you do with that? as an analyst. What do you do with that? As a non-quant analyst, no idea, right? But if you're able to link that quantitative statement with something that is more macro in nature and can be understood, you can have a view of what the yield curve is going to do. So, for example, say you find that the level of the yield curve, one of those three factors, is very closely tied to inflation. Curvature is very closely tied to the level of growth. Say, you use the unemployment rate. And the curvature is very closely tied to which side of growth you're coming from. So payroll growth, something like that. You're able to say, well, I think right now we're at this point, and I think because of what inflation is going to do, to some extent you can actually have fairly good models even in Excel that do that.
You said you can what?
Yeah, you can have fairly good models even in Excel that somewhat predict that. You can say, well, this is what I think the yield curve is going to do. So you have something that is very quantitative in nature, but very much applied and can be explained nicely.
Those are all of the questions that I have for you. Do you have anything else that you think would be useful to share?
We could talk hours about this stuff.
Well, I'd love to know if you have more. I mean, we do have the time blocked off. But
that's right.
So please just share whatever you think would be helpful.
What I'm observing right now as well is that we have a lot of algorithms come out with alternative data, right? Sentiment, for example. It's going to be super important because investment management is also about psychology, right? Money management is actually more about market psychology than about anything else. So asset prices only move if the market is going to say, and the market, but I mean, people deciding this is going to move. And of course, if the preconditions are set, right? So you don't have a market meltdown if something is super robust and everyone is calm, right? You can have a meltdown if something is fragile, so the market conditions are there, and then all of a sudden someone says, oh, maybe it's time to panic, and whoever panics first panics best. Alternative data is also a great usage. This new field overall, not just machine learning, in finance, that people don't use enough yet.
Interesting. Yeah, because we didn't have that in the past. We didn't have the models to quantify the sentiment.
But now, LLMs in particular, it's much easier. The latest I know is last year's Bloomberg approach to that. They go through reports or news reports, and then they filter out sentiment towards inflation, things like that. It's super helpful. But to build that, you would need some kind of knowledge, obviously. So that might not be the foot in the door for you guys, right?
Probably not.
If you find a very simple way to implement that, let me know, because I'm interested too. But maybe some libraries are going to be built.
Well, I know I haven't dabbled in this yet, but many libraries are emerging to help people apply LLMs, like open source LLMs, to data like this. So I imagine that it's within reach to develop like something like that on your own, maybe more so than it has been ever before, but I'm not familiar with it.
Yeah, I completely agree. It's definitely going to be close in time to have something like that, and to be able to offer something like that as one of the first in education for Python. I think that would be super helpful. Something that people love, by the way, sentiment indicators. Also because it's intuitive, it's a good selling point, right? Even in asset management, you always need to sell. You need to sell to your portfolio manager. You need to sell to clients. So something like that is always super helpful. There might be a lot of different usage of alternative data that I, as a global macro analyst, I'm a strategist, am a bit less familiar with. So
that's okay. We can stick with what you're familiar with if you want.
I can give you some examples, but
Okay.
not too much in depth. So for example, if you're an analyst in the oil and gas industry, satellite images are super important, right? You want to know what oil storage is like. I'm sure you've seen maybe. So what they do is satellite images of oil storages that are those round tanks, and then they look at the shadow that's being cast, and a larger shadow means that the level is lower.
Really?
Mm-hmm.
Huh.
Yeah. And now with machine learning, obviously images are much easier to interpret. So I'm pretty sure that something has already been built around that. I'd be surprised if not. If there hasn't, that would be an opportunity, most definitely. But yeah, there are industries for that, for which satellite images are super important. Shipping. Actually, my husband is a PhD in physics, and he collaborated with someone who, as a freelancer, who worked on a government contract to show where certain vessels were moving, to flag certain ships. So, shipping industry,
Using satellite images.
freight industry, yes, satellite images are huge. Also, in general, for global macro, just to know where exports, imports are going. See, I'm brainstorming here. Well, any kind of large data manipulation is helpful. So, my personal inclination, that was also my edge, um, was to use global data and try to filter out systemic factors in that data. And that was a bit different in how usually people do it. Usually, in global macro, what people do, be it on the sell side or on the buy side, is that they analyze on a siloed country by country basis. Maybe at most they say, well, now we have Trump, and so you're going to have trade wars, and so for China it's going to be more difficult, Mexico it's going to be more difficult for trade and whatever. But I've so far never come across research that said, on a global basis, we've had a huge momentum increase in trade in this sector, and a corresponding response in currency, and hence, usually in the past, this is what it would have done. The most that some banks do is they give you an indicator of, global trade. Okay, global trade volumes. Oh, and then people sit there and analyze in meetings, and they say, oh, okay, it's been up, so that means it's probably going to be more up. So usually that's the extent of analysis. That's most of the time being done. Maybe a little more sophisticated, but I've never come across some very systematic global analysis of country specifics.
When did you begin taking that approach, and what inspired it?
Yeah, that's easy. I started in 2016, actually, at my last employer, to have that kind of approach.
Okay.
Before, I always had a global macro approach, but more with this categorical classification, which I never quit. But the distillation of global data is what I developed and starting in 2016 at my last employer, which was because the portfolio managers, super experienced people, all in their 60s, having maneuvered through markets that I've only read about, they somewhat had that approach to some extent.
Distilling global data?
Yes, but not systematically at all.
What's the difference? What do you mean when you say that?
So what they would do is they say they go through country reports, most of the time produced by the sell side. That's how most asset management firms work that don't have an army of analysts behind them. They consume a lot
Meaning
of
some
research.
JP Morgan analyst is assigned to France and is producing reports, and they read that?
Correct. Yes. Yes, that's exactly that. Sometimes you have their economics desk that produces those reports, but yes, it's usually a country assigned person or people that produce those reports. Yes, then the portfolio managers consume that and try to determine where you are in the global macro cycle and try to allocate according to that. But systematically, it's very tough to do that, right? Because there is just too much data.
And so when
And
you say systematically, you mean like comprehensively? Like how can I get a look
correct.
at all of this data that's being produced by the sell side, for example, and distill insights that take everything into account?
Let me be more precise. It's not exactly what I mean. What I mean is that it might be possible to consume that sell-side produced research very well, but not every research is going to have all the data at any given point in time that you need, right? So, say to your example, the France analyst right now thinks politics are so much more important, so they focus their report on politics and don't talk about, I don't know, exports, right? And their export industry and what that is doing, or, their savings rate, whatever it is.
Mm-hmm. But maybe 3 years ago, they were more focused on exports and less focused on politics.
Right.
Which then makes it difficult to look at those factors over time.
In hindsight, you're able to look at those factors over time, but what you would like to do is look at all those factors and see which factor is moving out of line, right? So for example, I just for personal reasons, went through some material that I had from the sell side in 2017. And with that systematic approach, what you could clearly see in 2017 was that there was a huge increase in exports, global exports across all countries, global. So, 2017 was a great year in the stock market. It was a weak dollar, great. What every single shop was focused on was a very country-specific approach. Yes, China has had great growth, and we forecast that next year it's going to be somewhat similar to this path. Again, because analysts don't deviate too much from their forecast, right? So what you have is always some kind of extrapolation from the past for each and every country. So taken all.
Because I don't have any good reason to deviate from that. I would need to be very confident to deviate from what my peers are saying, but I don't have maybe the macro insight that would give me that confidence. But if I knew that trade is up across the board, then maybe I would make a different prediction. Is that the idea?
And as a sell-side analyst, no. Because if you're assigned to a specific country or specific industry sector, whatever it is, as a sell-side analyst, you don't profit too much from being away from the mean. Yes, ideally you want to beat the mean, but being too far away from the mean, you take a huge risk. Unless you have very strong conviction, the upside is very limited, right? If you're right, okay, great. Well, let's see your next call. And if you're wrong, you're axed.
Unless everybody else is wrong with you, and then you're safe.
Then you're safe. Exactly. Because if you're at the mean and everyone is safe, you can say, well, this was very hard to predict. No one was able to predict COVID. Sure, no problem.
Nobody had the courage.
Yes, exactly. Whereas, as a matter of fact, you were able to see pre-COVID asset price levels that were super elevated, respective to their fundamentals. So even absent of COVID, there were market conditions that told you, well, markets globally, it was equities, it was currencies, bond markets, super stretched. So what I mean by that is asset prices only move really if the preconditions are in place, right? Of
Psychology
course, only
can
burns
only take
if the
you
wood
so
is dry.
far.
Mm-hmm. So going back to that systematic approach. So what you have is research that is usually produced on a single country or single region basis. Sometimes there is collaboration. And then sometimes you also have global eco desks that give you more of a global view, but again, not necessarily super systematic. They have one indicator for global growth, one indicator for global exports, global export volumes. You can even download that, global export volumes. Okay, so it went up. What's the best extrapolation of that? You use some ARIMA model, and next quarter's, next period's data is going to be somewhat up, right? But if you systematically look at all single factors, the story might be quite different. And then the question is why?
And is this the reason why you say you build your model first and tell the story later? So let me see if I'm understanding what you're saying. You're saying the global data is available. So it's possible for us to look and see what this data is telling us, but most people, by assignment from their firm, focus on something more narrow. like a country or a sector. And so there's undervalued insight in the global perspective, which you've been able to tap by analyzing all of that data, leveraging your experience, your education in mathematics to develop models. I'm curious to know what gives you confidence in your models. I guess I don't understand what kinds of models you're creating, but you're creating some models using this global data and predicting changes and factors that will drive other changes in different asset classes to inform investment decisions?
Yes, on a broad level, exactly. More precisely, if you're in discretionary money management, again, you always need to ask yourself, does it make sense, right? Do you think it makes sense? And if you have models that tell you a story that's not the mainstream story, it forces you to be a bit more open-minded, really think outside the box. And it sounds like, ooh, outside the box. No, basically what that means is
thinking for yourself.
Yeah, exactly. Well, is there something that is being missed? And this is really where value can be created, right? Is there something in the story, in the market story, whether it is for equities, whether it is for global macro, whatever it is there something that's not being said, that's not being paid attention to at the moment? And usually, usually you can, when I say that is, that means it's not being reflected in prices. That's essentially what you want to see, right? That's how you profit from market prices. So this is my personal approach. I'm not saying that this is the best. I know a sliver of what there is to be known, but I personally like to go back and forth between the story the prices are telling and the story that the macro data or the data in general is saying. So to give you a super simple example.
Yeah, please.
Yeah. So let's stick to this categorization of those four market states, right? Most of the time, what you see is a certain performance of equity sectors that are uniquely different between those four states, right? In a recession, we all know you probably want to be overweight some utilities or some defensive sectors, and then you want to shift into financials as the economy expands and So, this equity sector rotation, it's well known. And what you could do, for example, super simple, is to see what the macro data is telling you, where the economy stands, and then you take a view on that. And then you look at the same analysis from an equity perspective. Well, is the market telling the same story? What kind of story is the market telling right now? Is it telling you we're close to a recession? If not, then, why not? Then you try to bridge the gap and see who's right. Market prices are always right. Even if you have a different view and the market develops differently, the market's right. You can't do anything about that. But this is how you can get information really and develop an edge.
What you would like to find, what you're looking for, is the market is telling me that we're in this kind of environment, but the macro data is telling me we're in a different environment. And I believe the macro data. Here are the reasons why. This is why equity investors are missing this factor, like not paying attention to that. So therefore, we're going to do something different than the majority. And we're actually right. And everybody eventually realizes it. And so maybe we're the first to buy or we're the first to panic or whatever.
Yeah. So ideally, this would be the exact approach that you should have in asset management, whatever assets you manage. Right? You try to figure out why a certain view hasn't been reflected in asset prices yet, and have a conviction of why they should be reflected and will be reflected, not why they should be reflected. That's a different question.
Yes, because then everybody else could do the wrong thing and you're stuck holding the bag.
Exactly. You need a catalyst. And, being late is being wrong. Or being too early is also being wrong. Because what they say is markets can be irrationally for longer than you can stay liquid. So timing also matters. But ideally, yes, that's precisely the approach that you need in asset management, right?
That's interesting. One question that I've been asking myself for how long? A little over a year now, maybe a year and a half, is what is Python exactly? I started this company back in 2018. I started learning Python probably in late 2017, maybe even early 2018, developed those algorithms that I told you about without deeply studying the language and contemplating the language and having much understanding about computer science or electrical engineering. And so a year and a half ago, I started asking, what is Python exactly? And was able to follow that question deeply enough that I was building circuits to understand logic gates, to understand what's inside my computer, to understand what exactly it is that I'm directing with this programming language. And it was good because now I have this solid foundation that gives me a sort of a conceptual context whenever I'm writing code and teaching programming. And I've also become able to teach Python more thoroughly, which I think, my hope at least, is that teaching Python more thoroughly allows somebody like a asset management analyst to be more creative, like to have the kinds of ideas that you're talking about and to have a level of mastery over the tool that allows them to just execute the idea rather than just having to find something that somebody else has made on Stack Overflow and copy and paste it, or even use ChatGPT but not really know what you're doing. I want to give people creative power. Another question that I've been wanting to ask, especially as Gil and I have been working on this marketing problem, although I haven't quite turned my attention to it yet, is what is finance? What is the finance industry exactly? I've been interested in going back and looking at the history of how capital markets emerged. For example, I know a little bit about it. I studied finance in school, but I could study it much more deeply. I've been wanting to go back and read the classic economic texts, Wealth of Nations and things like that. I've never gone back and read them. We didn't do that in school. But as a part of asking that question, I would also like to deeply, clearly understand what the different sub-industries in finance are. And asset management is obviously one of those. My preliminary thought is the economy functions to move the right resources to the right place at the right time, to maximize the production of resources and to move them into the right place at the right time.
Yeah, capital is attracted to growth. But then again, growth can't happen without capital.
And then, so the finance industry supports the economy. The finance industry is a part of the economy. It's not the whole thing. It functions to move capital to operations that produce the resources that we need, like the most valuable resources, and move those resources to the right places. And so I've been thinking the finance industry aims to allocate risk and reward optimally. I wonder if we could use that as a definition of the whole thing. And then it seems like asset management, I'm curious to know what you think about that. And it seems like asset management within that, asset managers are taking risk. Asset managers have cash and they're making decisions about where to put it. And they're asking, where is the insight that everyone else has missed? I don't know exactly what's going to happen in the future, but the present gives me clues and the past gives me clues. What clues from the present tell me what's going to happen in the future so that I can allocate this cash optimally? And you're saying you derived undervalued insights from understudied data by taking a global perspective when others were taking more narrow perspectives.
I wouldn't say understudied data. I would say an understudied approach, because the data was there. Everyone was crunching it, just crunching it differently.
Okay. What do you think about that definition of the finance industry?
Yeah, I don't have a great definition myself, so I take it. What I was interested in is your statement about risk and reward.
Mm-hmm.
I'm a bit more careful with that. Just because I've seen that a lot depends on the stakes that someone has in something, skin in the game.
What do you mean? I'm not following.
Yes, so what I mean with that, you said, can you repeat exactly what you said? I don't want to put words in your mouth about risk and reward.
I'm wondering if it would be correct to say that the aim of the finance industry as a whole is the optimal allocation of economic risk and reward.
Yeah, I'm much more cynical than that. I think the finance industry is a tool to provide everything that you said, financing of the economy, financing growth. Basically, it channels opportunities of growth and take them away as well. But risk and reward, I'm not so sure about that because it depends so much on the stakes that someone has. For example, financing now is determined by banks, right? And people who channel that money to someone or some company or whatever, there are people behind a desk. And if they take bigger positions and they're allowed to, we've seen that in 2008. Not much happens. How many people went to jail? One. Yeah, I think one, right? Um,
Oh, so you're saying the person making the decision doesn't have sufficient skin in the game to be appropriately risk averse.
yes, correct. So
Hmm.
there was always,
Whereas somebody like the research analyst, the sell side analyst, doesn't have enough skin in the game to make a courageous statement about the upside.
yes, yeah. So that's a bit of an issue. And then on the personal side, because what is money? It's what someone worked for, right? It's just a different expression
Um,
of
value
work.
abstraction.
Yes, exactly. So on the personal side, we also know that people are not necessarily risk averse, right? We have many people who, as personal traders, underperform because they over leverage. I've made that experience myself, so it's super easy to lose money just because you're over levered. Yeah, so I'm not sure how to define risk and reward in that perspective.
Well, the reason why I came to that preliminary conclusion, which is definitely preliminary, I'd like to give this more thought before really concluding that I have made a good definition. But derivatives allow us to hedge risk. So if I am an airline company, I can trade oil and gas futures to hedge my risk. I could take that risk myself and open my company to the possibility of making outsized profits at the risk of incurring outsized losses if oil and gas prices swing in my favor or against my favor. Or I could buy options to give that risk to somebody else. So the finance industry, or at least one thing that the finance industry does, is it provides these instruments that allow us to exchange risk as such.
Yeah, they're brokers of risk.
Yes, right. Which is different than production. Like it's different than operation, like operating a factory.
But that's only one part, as you say, of finance, right? That's only intermediaries. There's also the part that actually actively takes risk on behalf of people who earn the money. Potentially, you could also define them as brokers of risk if you want, but it's active risk takers.
And advisors.
Well, advisors don't necessarily take risks. They only tell you to take
Well,
risks.
that's why I say and.
Oh, yes, okay. Well, right. Whereas, you have those who pass through the risk. Like real brokers, they don't hold they don't hold net positions. They try to even them out, maybe even at the end of the day. And then you have those active risk takers that are potentially also brokers for others, pension funds, insurance companies, or private people. And then you have the masses, the privates who actively invest, and the companies, of course, that are on the other side of all this chain.
Well, so within the finance industry, what would you say is the ultimate aim of asset management? At least the part that you've worked in. Like, what's the point of the whole thing if you're going to sum it up simply?
Ideally, outperformance of the market, but let's be honest, the goal of asset management is wealth maintenance. Maintenance of purchasing power of the money that you trust in me. Basically, we're all saying, yeah, we don't want to, we outperform the market. We promise that we will do our best to outperform the market, yes. But let's be honest, our real goal is to not lose your money. Yeah, there is this famous book, it's called Where All the Customers' Yachts. It's basically, the people getting rich are the people managing the money, not the clients.
Where are all the customers' yachts?
Yeah, it's a pretty good book.
That's interesting.
Yeah. And a lot of people go into the asset management industry because it pays well. It probably pays too much for what people produce. Very often the bonuses aren't justified, um, or the management fees aren't really justified. This is how the industry has been set up. So
Yeah, I've thought about that too.
it'll change.
It makes me think of Judas and the disciples skimming off the top of the money that was given to Jesus.
Oh, that's quite the parallelism there.
Well,
Okay.
it seems like a pattern. Like
Yeah, it's human.
the person who manages the money has the easiest time skimming off the top. So the temptation's more present than it is for anyone else. And
Sure.
so, yeah.
Yeah,
So
that's very true.
I worked in investment banking. Our bonuses were huge. Like we made half of
Well,
our money in
asset
a day.
management. Let's talk.
Yeah, yeah.
Yeah, but I mean, in your guys' defense, usually the amount of work that investment bankers put in, if you just break down the hours, pay is not that high
Hmm.
by the
Yeah, we
hour.
talked about that too.
Yes, by the hour, not that great. If you go into asset management, by the hour,
Maybe you have time to play on your yacht.
yes, exactly. Exactly. And I do personally hope, just for the benefit of people, because I actually like people, is that with all the tools that are coming up now, there is somewhat of a, I don't want to call it revolution. It's like, but people have more power to do their own analysis and make their own decisions.
That's interesting.
Um,
That's interesting. I've shied away from marketing Python to people, to individuals who want to use it to analyze the markets. And the reason why I've done that is I've thought I was not a trader, but I worked on a trading floor, and that was a private trading floor, but below was a public trading floor. I know there are traders there. I've talked to the people at Neuberger Berman. I know that there are people doing this analysis, deploying capital, who are very sophisticated and well supported. And I don't want to promise fairy dust to individuals and say, if you have machine learning, then you'll be able to outperform the professional trader at JP Morgan. But it sounds like what you're saying is the asset management industry might be slightly overly risk averse because those asset managers are more interested, kind of like the sell side analysts, in not losing what has been entrusted to them than they are in growing, so that an individual who might be more appropriately risk averse, meaning willing to take a little more risk than the industry as a whole, could actually find an advantage.
that's an interesting point. I never thought of that in this fashion. I'm not necessarily convinced that as an individual you need to be more risk friendly to outperform. I think what would already be helpful is to have some knowledge, right? A lot of people don't necessarily have the knowledge to make decisions that are well informed.
Such as understanding which sectors you want to be in different parts of the economic cycle.
Let's make it simpler. When to invest or when to stay out of the market, and you just use simple ETF, broad market. There is many research out there that's saying, well, you should always be invested, and it doesn't matter when you invest. Well, that's not true. You just run the numbers in Excel, and you can see that it usually matters, even if you invest every month. If you invest at the beginning of the month or at the end of the month, in market downturns and upturns, it matters hugely. If you're able to just sidestep the worst of the market, you vastly outperform. Having said that, you also underperform if you miss like the best 5 days, of course. Yeah, that's a definition of distribution, of course. But it's not that difficult to sidestep if you just use some common knowledge, right?
Like what? How would an individual investor be able to time that appropriately? I've always assumed that that is not possible for an individual
Well,
generally.
yeah, I'm not sure that's depends on how you define the median individual. If you have some knowledge of what is going on in the economy, to some extent you're able to sell, well, we're expanding or we're actually not expanding, right? Or at least if you don't want to make such a drastic decision, be able to judge if the advisor is telling you something that's actually not aligned with reality. So to give you a super simple example, in 2021, energy markets had a great run, and my neighbor actually came up to me and said, well, I talked to my advisor and I wanted to have your opinion. I'm not an advisor. I'm not registered or allowed actually to give any investment advice. So, he said, well, could you go over and show me what you think? Okay. So that advisor had something structured that completely left out energy. Why? Why? If you just took the most simple charts, or momentum indicators, whatever it was fairly clear that you should have at least a little allocation to energy. Things like that. Some common sense. Have some conviction in what it is you're doing, or in the advice that you're given.
It's interesting. There's a quote from Ralph Waldo Emerson that I like. He says, "Perhaps the eye is placed where a ray of light should fall, that it might testify of that particular ray." And it comes to mind as we're talking about asset management, because even though the market, who are you to say that you can beat the market? At the same time, maybe you do have a perspective. Maybe if you would just take a look and use common sense, you could find a useful insight that could lead you to make a good decision.
Yeah, I mean, not necessarily. Let's take a step back even further. You don't necessarily need to beat the broad market, but what you need to maintain at the core of every human being is the ability to provide for you, your loved ones, right? So what you need to maintain is your purchasing power that you would like to have. So how do you do that? Ideally, by not losing money, ideally by making money, and to make certain decisions that are well-founded. So not just let's take a step back from asset management. If you work in a certain industry and you want to switch jobs and you have to decide, well, where do I move? Which kind of job do I take? You kind of have to have a view in the industry if you're not completely right. So, or say you made a lot of money in the housing market in Florida, okay, and then you say, I think this market is somewhat hot. Should I sell? If so, where should I move to? These are important decisions that can actually really make or break. Or you're an entrepreneur and you have to decide whether to expand or try to maintain and build cash reserves. You look at the economic cycle, if you can, if you're educated enough in that perspective to be able to do that. Sometimes, actually, interestingly, the small entrepreneurs do that very well. They're very astute. They know exactly, I can see my client base is, getting a bit more stingy. Oh, that's not a good sign. Sometimes they do that a lot better than the broader masses.
Don't have to pass an idea through an investment committee.
Yeah. Yes. Yeah, exactly. And a lot of common sense. Have you ever seen that meme with the distribution in asset management, like intellectual distribution?
No.
Yes. Yeah. So basically, the ones who really win out in markets are the super intelligent and the really not intelligent. But the median loses. It's really true. It really is true.
Yeah, you just hope you're the one and not the other.
Yeah. That's true. That's true. Or you go with the masses and then say, well, everyone else was thinking the same thing, so hey.
Yeah.
Okay,
everyone was
wrong. Together.
Yeah. Okay, Dorothee. Well, I appreciate you doing this call with me. I've learned some useful things, and that hopefully will help us to have a perspective that we need to make the right investments in how to serve people best by teaching Python. So thank you.
It's been a huge pleasure.
That's all for today. If you enjoyed this video, please give it a like, and if you want to see more, subscribe, and I'll see you in the next one.